Good day, everyone. Thank you for
Hey,
joining us on another live event with Nestwich Cyber Risk Governance. And today we are very fortunate to have a guest, Steve Walker. And I'm going to let Sean to introduce Steve.
yeah. Steve had a long career with the Office of the Comptroller of the Currency as a bank examiner, and with that role and function that he played within it, brought a lot of expertise and developed a lot of expertise in regard to technology used in the financial services and the banking industry. And so today we want to talk about cyber resilience, not only in the financial services industry, but in banking, and more specifically with the NCUA members because of a recent event with regard to Patelco. So, Steve, welcome. Thanks for joining us today.
Thank you
Thank you,
for
Steve.
thanks for the
So,
invitation.
as we've witnessed, cyber attacks continue to target the financial sector. A recent report found that banking accounts for 20% of all ransomware attacks against the banking sector. And the recent ransomware attacks to Patelco Credit Union serves as a reminder to the risks the financial services face. To put Patelco into some context from a cost perspective, the incident cost the credit union more than a week of operations, has affected thousands of customers, creating a negative reputation and a lack of trust amongst that customer base. And now Patelco faces investigation with potential fines and penalties from the state of California due to CCPA, and they've been named in a class action lawsuit brought against the credit union by its customers. So, Steve, with that kind of setup, what specific benefits does the OCC's regulatory process offer credit unions in terms of operational risk management?
Well, um,
Not to put you on the spot or anything.
yeah, exactly. I guess I want to just kind of a little bit about my own background just to start. Yes, I do have a strong background in information technology, supervision, and regulation. But I actually started my career as a banker. And I'm quite proud of that because what that did in starting in that particular regard and direction gave me an awful lot of insight into how financial institutions operate and how they are motivated in terms of what they do and how they deliver their service from a safety and soundness perspective. I think when you
Okay.
first start talking about this particular area of supervision and supervision by risk, or even enterprise risk management, it's always caveated with a backdrop that much of what happens and much of the management decisions that are made from the standpoint of cost
Mm,
as well as risk.
right.
Now, having an industry background in corporate lending, which is what my background was when I was a banker, and then going into the regulatory space, helped me to really understand the expanse and the potential opportunity costs, as well as the risks in the information technology space. And I ran into that quite a bit across several reviews over many years that I did with the OCC. Now, when you ask a question like, um, how can the OCC's approach toward this particular area help NCUA or credit unions in particular? Understand it from the standpoint that credit unions, from my understanding, are owned by their members, but they're owned to be able to operate at a reasonable profit so that they can continue to provide quality services to their members and to their customers that they do business with. In terms of the structure, they structure and operate very similar to regular financial institutions, regardless of what that institution's charter is. Okay, so from that standpoint, it's beneficial for NCUA regulators as well as NCUA members, managers of those institutions, to familiarize themselves with the best set of standards and the most holistic set of standards that is going to operate within the context of your risk management profile and your appetite for risk inside your institutions.
Right.
Let me bring back one step about when you mentioned about costs. So from a business point of view, to me is three things. Either or from technology helping business is either I'm going to make money from technology, I'm going to save money from technology, and now the third category is how do I protecting my money with technology. And that comes into what you refer as costs, because a lot of board of director executives, they don't look at cybersecurity as a way to help them to protect their money or saving money. They're just looking at is spending money. Well, 72% of the CEOs undecided what to do with cybersecurity, according to Oxford University's research last year. And that leads into what we're doing is how can we do it as a cost justifications in risk management, cyber risk management, and particularly your experience, our experience in the technology sense, to basically how can we address that issue to get the CEO or the stakeholders to decide what do they want to do with this cybersecurity, this thing called cybersecurity.
Mm-hmm. Sure. And that's a reasonable and it's a universal concern among all institutions, irrespective of the charter, irrespective of the size and the complexity of the institution. All of them are going to be.
Or even nonprofit organizations need to protect the investment too.
Exactly.
Yep.
Exactly. I would say this, irrespective of all of those issues playing off of one another, one of the things that the Office of the Comptroller of the Currency began to do, and we began to advocate this with insight, as I recall, several years ago within the FFIC group.
What is the FFIC?
The Federal Financial Institutions Examination Council.
Great.
That's what the acronym stands for. And it's a group. It's a group that largely exists, and the NCUA is part of that group, by the way, as well as the CFPB, as well as the regulators, the primary regulators being the Federal Reserve, the OCC, and the Federal Deposit Insurance Corporation. All are members of the FFIC. Within the walls of the FFIC, we advocated several years ago to begin to put cybersecurity, cyber risk, information security risk professionals at the board of directors level inside of these institutions, because we wanted to see one, perhaps even two people on boards in these institutions, almost regardless of their size, that had an expertise in this area. And our thinking behind that at the time was once you put the expertise in place, these professionals will begin to ask and articulate ideas at the board level, participate on board committees, do their own level of independent investigations into the activities and practices of these institutions. From that standpoint, it was our hope that these institutions would take more safety, more precaution, and talk about technical controls inside their environments more than what they did when these professionals were not involved at the board level. They could also
So did the Patelco incident shatter that hope?
Well, I would have liked to have known more as I read about Patelco and the issues that went on there and the findings that was shared publicly about what that was, particularly when you look at the payload of what the hack actually yielded.
Right.
You would hope that there would have been someone at the board level inside that organization that would have been articulating about the control environment, about the information security posture of the institution, the network structure, the network controls, interviewing not only just the CIO of the institution, but inquiring with the CIO what kind of standards and expertise were they seeking to bring inside of the organization. That's where we would look to the minutes of the board of directors and to the minutes of the committee structures that these individuals participate on to see what was discussed and in what time frame and in what manner were these issues discussed and highlighted at that level. And the reason why I say that is because very often I've been involved as a lead regulator where I've had to look at and review these types of documents at the board level, and it has formed the basis of a matters requiring management attention or matters requiring attention issue inside the organization, that there are insufficient documentary details about what's happening inside the institution. Okay.
Why this?
So if we want to just start there, we can start there and work our way down. Okay.
Yeah, and actually, this is where why I asked the question. Why do you think that a lot of organizations even fail, or in layman's term, ignoring the regulator's recommendation? Why are they ignoring it? Because it's supposed to be good intention for themselves to have a sustainable business.
I don't necessarily think, Stanley, it's that they're ignoring it. I don't think that ignoring it is the real issue. I think that in many instances, it's the dawning and the occurrence of asking the question. I mean, once the regulator finds the issue is one thing. Okay, if I go through and actually run an examination and myself and my staff come out and we have these list of issues, that's one thing. We found them. They didn't know that they had these gaps or these weaknesses inside their organization. And that's it. They're there. They are what they are. And then you agree to a corrective action. You agree to a time frame for correcting that, and you move forward. That, to me, is not ignoring the issue. The issue actually happens before that, is that the management, the board structure that's in place didn't know what they didn't know. And so they didn't
what we've been talking about, you got to know the unknown, right? With the baseline assessment.
Exactly. That's where.
And I think back then I still can use the excuse, well, oh, sorry, I didn't know. And as a regulator, you would say, okay, now you give me a corrective actions, you give me a corrective plan. Okay, no big deal. But nowadays, the environment is completely changed. It's not waiting for the examiner to tell you that you have not done certain thing. It's really the hackers or the cyber criminal. They're going to knock on your door. Hey, we found out what you didn't do. And it's way too late at that point.
But on the control side, let me take this additional step forward and one step, I think, to the right on this. I think that if management didn't know what they didn't know, that is the purview of the internal audit and control structure for the organization to point that out to them. they are supposed to sit in a sweet spot between what management does, which is their responsibility to manage the organization, and be the independent eyes and ears of that group and report on any of those gaps and weaknesses that they find. Now, it changes the dialogue a little bit more if internal audit finds these issues and then management ignores them, even though they too give them corrective actions and timeframes and agreed upon timeframes. If they ignore them, then now they have an even more serious problem on their hands, because regulators are going back and they're looking at the sufficiency of audit, the qualifications of audit, and their expertise to be able to highlight and identify these issues and report to them in a timely manner to the audit committee of the board of directors and to senior management, and then follow what those corrective actions and timeframes were that management agreed to do, to see if management in fact did do these things and if they should be clearing them as exceptions. That's the way the whole loop in the process is supposed to work. So if we find an issue like this, we are also going to take the additional step and identify, well, what was internal audit's role in all of this? And did internal audit miss these issues? And if they missed them, and we feel like this is fairly obvious and low-hanging fruit, then we will have to start to ask questions about what is audit's qualifications to perform its role.
Do you ask about the qualifications of the board members at that point as well?
Sure. It's less stringent on board members when we look at what their backgrounds were from their bios to see what level of expertise they actually originally came on the board. In smaller institutions, it's more of a confining type of thing, right, where these are more community leaders and so forth, right, from the community in which the bank has its primary CRA delineated area. That's where the men and women are coming to serve at the bank. But as that bank increases in size and complexity, and they begin to look at board members, and as their product offering gets more complex and has a further outreach into the community, we begin to look at the expertise that members of the board begin to bring into an environment and where they're going and what they're doing and what they offer in the way of communication. We can glean some of that from looking at a year's worth of board minutes, for instance, or a year's worth of key committee minutes, like the audit committee of the board or the marketing committee of the board of directors or the technology committee of the board, and how they're actually approaching their roles and their responsibilities. And we're also looking at the board package reports. What actually gets reported to the board, in addition to just the financial statements, in addition to just the new projects that were approved, in addition to just the new loan relationships that got established maybe within the month. We're going to be looking at what are the findings, what is the Information Technology Committee bringing to the board in the way.
With that said, one of the conversation we had with credit union auditors, internal auditors, they have over 150 different processes needs to be audited, and ties that, put that in a framework as a context, tied it into your reference as cost to the board of directors, to the stakeholders. For us, is justifying that cost, applying into that 150 process in an ongoing year-round basis. How can doesn't matter what size of the credit union, how many members that they serve, that 150 in average 150 processes is going to cost some money. And as the regulations continue to increase, or more stringent, like you mentioned, because now the SEC also overlooking into certain financial aspect of their product as well. That makes it a lot more complex. How is there going to be, how are the internal auditors going to manage those, continue increasing processes with the same resource that they have? And
Sure.
in the industry is lack of talent. We know that because we've seen that all the time. Is always in United States is about 500,000 for the last 10 years that I see that record being talked about. It's always a 500,000 shortage. And now because of the complexity, tying in technical and GRC risk and compliance and governance processes, what is your recommendation? How do you foresee this is going to, the industry needs to adapt?
Well, I think probably like a lot of other industries and even financial institutions have tried to adapt to this. One of the things that I recommend that they do, if they don't already have it, is to formalize their risk management processes. Because the risk management processes, in terms of the entire spectrum of everything that flows through an enterprise risk management function, should be able to opine and to provide them some idea about what those risks are that they're facing and what those risks are, or what those risks might be that they're missing. So when it comes to some information that you have about your institution internally, about what risks you're missing and where those potential gaps are, you look at your staff and see exactly and take a temperature of exactly what level of expertise you have. And what a lot of these institutions have looked at and decided is that we don't have the expertise already on staff. We're going to look to and need to bring it in externally if we're going to continue to offer a baseline level of services, or if we're looking to offer an expanded level of services to our customers that's being driven largely by competition. Okay, we've got to look for the expertise to come in and provide the project management, help us decide on what level of sufficiency that we're going to provide an oversight of that function. We're going to be looking to augment our staff with expertise from an operational level, or we're going to be looking to bring in outside consultants that's either going to augment the operational staff or augment the oversight of the function so that we can take charge when we find and identify gaps in controls. That's how most of these institutions are operating. It's really a pretty baseline, vanilla way of approaching an issue like that. If you've made a decision inside your organization that this particular posture, these particular suite of services, this particular suite of products makes sense for us to be offering our customer base in our market so that we can protect our market share.
So if I kind of paraphrasing what you just said, and to me, it's always the rule of three, right? So how can we go from strategic level to the approach and to tactical? The strategy level is what we've been talking about. To all our listening has been talking about NIST 8286,
Right.
integrating cybersecurity and enterprise risk management. That is the strategic level, and I dissect that publications inside out, and then it breaks it down into basically the approach is three things, right? In our NestSwitch, kind of formula, if you may. The approach is risk register, cybersecurity risk register, the risk profile, and then risk quantification. So of course, these are the rule of three, right? So in simply saying, that's the approach. And then down to the tactical, we focusing on the data analytic portions of it. and how do we using the data in your existing tool, not adding any more new tool at this point, to create the baseline using business impact analysis, going back into my school days of, fundamental, how can we break it down into business impact analysis, and then going into the technical baseline, creating the baseline, and then the GRC creating the baseline as what NIST 8286 refer to, cybersecurity risk register. From the risk register, using the data to drive the profiling, risk trending analysis, and then getting to the risk quantifications, which is another subject on its own, which we talked about it 2 years ago already with Dr. Mustafa, Dr. Carver, Mustafa Carver, a long time ago. So, and would you agree business impact analysis is something that they can do it on their own? Obviously, we because we're creating a playbook and sharing it to our members, the template, so they can get analysis on their own. And would you, and jumping forward into the end result as an expectation, would you see that as helping their cyber resilience maturity? I know I mentioned, I talk a lot of, 3 different levels, so I give you some time to digest, and please feel free to ask me questions.
Okay. I may have you just kind of refresh me on those 3 different levels again. Sure. But yes, the business impact analysis, because of the way that got introduced to me several years ago, I still think of it this way. So if there's some, you can detect some dating in my discussion, then that might be the reason why. But the business impact.
That's why I say you got to wisdom. It shows on your beard.
I have the wisdom beard. Yes. The business impact analysis is a living document, and that document is largely a risk assessment, as you have aptly pointed out. It has been refined over the years to talk about the document as a risk management document in terms of the register and how that profile informs the risk appetite and how the organization actually moves to an analytical point of what they think their risk appetite is. But that risk appetite number is an institutional number, so it looks holistically. The business impact analysis from that standpoint is a document that I look at not just for cyber, but it looks at and takes into account and factors the entire enterprise.
Right.
It's all of the risks that the institution, yes, identifies as part of the risk register. In that register, it should be risk identified and prioritized, because that prioritization is going to impact the business contingency aspect of how you recover the operation in the event of an interruption or breach. And if you face a long-term situation there. The business impact analysis also should take into account and factor the human risk of all of that as well. Do you have the human resources to be able to manage the risk that you've identified in your register and prioritized in terms of the restoration of those functions inside the institution? I look to that document to inform me a lot about that institution and its posture, from whether or not they believe that all or some part of their operation should be recovered on a hot basis, or all or some part of their institution should be recovered on a warm basis, or some of it can be recovered in a cold basis. Okay, not everything needs to be integrated all at once. And in the risk register, And the prioritization will tell you what services need to come up and then what risk, at what risk point objectives and risk time objectives inside of your organization. Now,
which is why I bring it into the long way and going back into what you said earlier is about the augmenting resource, because we don't have enough talent. Let's face that challenge first things, right? And using the BIA for us is just opening up the communications. Then we can evaluate what kind of resource that we do have currently, what kind of budget we need to plan, who should we select it as our trusted partner in the future. And it's part of starting with the BIA. And as I said, for people that knows me, that I work with universities, work with students, it's like, look, some of the as fundamental as an undergraduate or graduate student, you can engage this type of communications with some of your local businesses or the mom and pop shop, and just creating that communications, adapting into the rule of three type of breaking it down into smaller chunk and digest it over time. I think this is what the business need to step back and look at it. And you taught us about the CAT tool that was offered from FFIEC at one point in time. And now it's on the way out, but is still applicable in a lot of ways. And these are going back into the augmented intelligence, not necessarily that it has to be done by hiring the top level consultant to get the work done, because they need to cost justify this. And it can be augmented if somebody, like you said, managing like a project management type of role with the internal auditor. Let's break it down using the BIA, what kind of resource we have and what we don't have. How can we engage in the community like ourselves and the university and the different community college level with the students? So creating the future workforce development, get them some experience that they needed onto their resumes. I just want to frame this conversation in a way that it is very practical for the board of director, for the stakeholders that they can consider, and it doesn't cost them that kind of money to engage with the big fours.
Yeah, and it makes sense.
And leveraging the tools, like you please speak more about the the CCAT tool that you mentioned as part of the baseline analysis.
Yeah, the CAT tool was. When that document was being developed, I was kind of on the tangential side of that. As it was going on, I had a number of my colleagues that were directly involved in the development of that tool. It was a terrific tool that really basically went back into and looked at what were best industry practices in the financial banking arena. But it also used as tools of its work steps the FFIEC Information Technology Handbook materials. The handbook materials, of course, if you go out to the handbook.ffiec.gov website and you pull that up, you could toggle over and see exactly what those handbooks, those volume of handbooks were and what they currently still are and what they're identifying. We went through and took each one of those handbooks. The FFIEC working group that actually did this, it took them a little bit of time to do this, as you can imagine, several months, maybe even a year or two to actually come up with this CAT tool. And they looked intricately at each part of those booklets to see how they integrated. That was the beauty of that document, because it would take one particular category, and the categories that they talk about were several in nature. I have a few of them listed here. I'll get to it in a minute. But for instance, management. Management actually appears in several of those booklets, not just IT management. There is audit management. There is management of development and acquisitions, which is the old systems and programming stuff. There's management for operations and infrastructure. And so what they're doing is they're taking management from each one of these various booklets where it's found and what the objectives were for each one of those, and they're marrying them under one heading. And they are not doing an examination on an institution. What they're doing is attempting to do what you're doing with Sarah. They're attempting to try to establish a baseline. And so they were going in what we were doing. I actually headed up a couple of these CAT tool reviews. What we were doing was we were going in and identifying a readiness for those institutions. And the readiness of the for this in terms of the result that we were bringing out was particularly helpful for those institutions that were de novos. They had never been examined before because they were brand new institutions, and they were extremely helpful for what we term to be well-managed institutions that were 1 or high 2 ratings, where they would only get regulatory visits up to 24 months. Okay, so there was no regulatory visits. There may be some off-site contact by the portfolio manager, but it was off-site. There was no regulatory eyes looking at the intricacies of the details of their policies, procedures, the standards, and the controls in that institution because of the regulatory history and the rating of that institution. Okay? And so when we went into those institutions using this tool, it was enormously helpful to find out where their baseline was in all of these various areas, from management of technology and cyber in this particular case, all the way to network operating controls, all the way to backroom operations and controls, and also an assessment of their policies, procedures, and standards. And one of the very best things, and this is one of the things I can, because I've definitely said this to many institutions along the way, is that I said it in these institutions, but I said it a lot in my regulatory years doing regular full service in examinations of all types, whether they were safety and soundness, information technology, or trust asset management exams. I always said to those mid-level managers mostly, if you and your staff are doing anything that is not identified in your policies or your procedures or your standards in order to make this system work, in order to achieve the objectives and goals of the institution, you could be taking career risk because they are not documented, okay? And if something goes wrong, a defalcation takes place, a lawsuit occurs that is quite substantial. This is something that you need to have an awareness of, and you likely need to cease and desist what you're doing until you actually get this issue resolved and document it in your standards and in your procedures. Okay? That usually rings home.
Yeah.
This is why we keep talking about, from our Nest Switch point of view. The first line of defense nowadays, with the adaptive strategy is, do you have cyber insurance? Are you able to qualify cyber insurance? Now, jumping to what, kind of summarizing what you said, to the last line of defense, which is the key point, is, do you have the legally defensible evidence as a stakeholder, as
Yes.
a IT operator, network engineer, help desk support. Now, is your organization from a strategic point of view benchmarking against any of that for the cost justification in that process from the first
Precisely.
line to last line? So
That's right.
benchmarking, that's why I want you to talk about this CAT program. Yes, it might be outdated. Well, I know it's continue updating with variation type of framework. But the
Mhm.
important part is in that cost justification process, starting with what you mentioned, we offer Sarah security and risk assessment as a creating the baseline. It's just to start this uniquely defendable evidence trail and journey to making sure that we continuously measure it against a particular benchmark that's selected by the organization. But more importantly, with the BIA and Sarah, is to create that baseline for communications within the organizations so they can start collaborating and measuring to a certain benchmark that they're selecting as a part of their cyber risk management.
Absolutely. And, if you'll indulge me for just a minute, with respect to that particular tool, I can take you just a couple of things that the tool looked at. The tool, as I indicated before, it attempts to be an aggregation of the FFIC IT standards in their handbook. Okay. So, for instance, when we talk about management in the tool, it was labeled and identified as IT asset management. Okay. Which is a little bit more of a broader term meant to capture governance risk assessments, risk management strategy, and supply chain risk management. Okay. That's what that was supposed to do. And it was supposed to discuss the administration of logical and physical controls, the use of multi-factor authentication methods, remote access on all platforms inside the organization at the enterprise level, provisioning, network segmentation, and all user access. And what they did is they just aggregated underneath that work steps that came out of the various handbooks that talked about awareness training, data security, which is confidentiality, integrity, and data availability, your mobility programs, and any use of apps that many institutions started putting in, which led immediately to the discussion of exactly what is your patch management and your version control activities inside your organization. And then we talked about management system capability and information protection processes, and that would be incident response, recovery testing, strategies, and the communication of that in the event of cyber issues that would take you into the public realm. That was the
I love the way you use. I love the way you're using aggregation is the term for that, because in the data analytic world, we also use aggregating and normalizations to build the database so we can continue to evaluate whether a garbage in, garbage out.
Exactly.
But more importantly, tied it into the AI. Of course, every webinar cannot go away without talking about AI and technology. But what we've been talking about is augmented intelligence, not artificial intelligence, which is what we are trying to do, is augmenting this communications with aggregations from the risk perspective, and then we put it in the augmented intelligence aspect of things. That's another topic on its own, but which we will touch on. Want to ask your expertise on the balancing between innovation, risk, and fintech, AI, and blockchain, right? So we'll touch on that.
Mhm.
But the aggregation and normalizations select a benchmark to measure and monitoring this continuation of the journey on an annual, semi-annual, or even 5-year, let's say, a roadmap perspective. And what I can keep saying, aggregating is the word, is also part of the integration. It's not like that we are reinventing the wheel. We just need to make it more efficient. And that's the goal. And for us, it's always how can we make the operational more operational functions in the tactical more effective to meet the cost efficiency and justifying the GRC objective. So along with that, we got about 15 minutes left. So we're going to change the subject a little bit. I think it's fascinating. I would love to continue to talk about this. Steve, you and I talk about this a lot already. But let's change the subject, jumping into the emerging technologies. Because part of what we talk about as an adaptive strategy is you have to be aware what's going on from an innovative, including the credit union itself, that how can they adapt into the innovativeness of what's going on in in risk management, AI, and whatever technology that is coming on board. So this is the part that is throwing them to me. I think that from my experience, humble experience speaking perspective, it throw another curveball to the board of directors, to the stakeholders when they don't talk about technology. And that's why 72% cannot decide, because, well, if I'm going to invest money today into AI, let's just bring that into the conversation again. But how does that going to be helping my company for those three buckets: save money, make money, or protecting my money, as part of the cost justification process? So from your perspective as a technologist, as a regulator as well, please share your view. What is all these emerging technologies going to help them either save money, make money, or protecting their money?
Well, I tell you, as a regulator, particularly a lead regulator, I met a lot with C-suite people and boards of directors. One of the most difficult, most challenging aspects of what it is we did as regulators and do as regulators is having conversations with people at that level who are stakeholders, but also tasked with the responsibility of stewarding and managing the budgets of their institutions. One of the most difficult conversations you can have is to talk about, you don't even have to talk about emerging technologies. You're talking about existing technological states. To have these men and women who are very well-intentioned, very knowledgeable, and very smart, typically very tied into their communities, and so have an awful lot of ways of gathering information outside of the institution, which is why they were put in that position to begin with. Talking to these people when times are good about why they should be investing in technology, in new systems, in platforms, not only in their existing state or in an emerging state like blockchain, perhaps like artificial intelligence, perhaps in green technology space, which hasn't gotten as much press because of the climate issues that we're facing. Convincing these stakeholders why it is you should justify the cost, because it is going to help you better deliver your products and services. It is going to enhance your security in your current state and any future states that you choose to bring in-house or through a third party. And I believe if you scale it right and scale it over time, you will find you will save money. because of the way in which it changes the way in which you look at risk. You don't look at risk necessarily as immediate as someone breaking into your system and stealing a lot of money today. You look at risk over time, that someone has intruded into your system, monitored you for a number of months before they decide on what level and how they want to approach getting a payload from you that is going to harm you. And it's going to cost you more money to recover your operation, because you're going to be in disaster recovery mode for a much longer period of time. Okay? That's a difficult discussion to have if you don't have an audience that's receptive to it. So therefore, how do you do that? You have to take the time to educate your audience. And your audience isn't just persons that might be tuning into our discussion today. Your audience are going to be those C-suite people and those board members that are going to be sitting in their institutions. And those are the people that you have to capture. And as a regulator, I've always felt it was my role to educate those people as best I could, as thoroughly as I could, with a mind's eye toward their budgets, or perhaps their stock price, or perhaps the guidance that they were giving the street about projects that they had approved, and they had made disclosures to stock analysts about what future earnings per share would look like. Those are real issues for that group. And they're the ones that are going to be making the decision in the context of what it is that you're talking about.
It actually, it ties into what I was going to say is, from the risk management perspective, that your language speaking with the board and the C-suite, our language talking from the IT, from the bottom going up, right? So you coming from the top down, we're going from the bottom. But the part of it, of course, in the previous, years, that they don't talk to each other, they don't want to communicate because they look at it as we speaking a different language. That's why we call it an acronym battle, right? From day one, and when we putting out this initiative. So part of the process is looking at the current technology and to identify whether that is a risk on its own, because it's been sitting around, it's already manufactured, discontinued for X number of years, but the management doesn't want to spend money to replace it. Now that particular technology may be only using by 1% of their staff within the organization, but it might be creating 80% of the risk. I'm exaggerating as an example. But nobody come and look at that 1% of the technology because it's always there to, oh, you know what, we don't want to look at the money. It's a necessary application that needs to operate a certain part of our business. But because it's been running, you know what, I don't want to spend money because it's only being used by 1%. Although that if with that 1%, it could trigger into the 80% of the risk. But let's continue to milk it until we have a problem with it.
Well, Stanley, I'll tell you this with respect to that point that you're just raising now, is that the real quick reference to that is to go back to that business impact analysis and look at that risk register and find out how that particular service is prioritized. And if you were to have a shutdown or disruption or a hack or something that interrupted that processing and control, do you need that? Is that mission critical for your customers? Because it does have an outsized impact on your institution's profitability.
You're absolutely right. Thank you. Thank you. And exactly what I keep advising our client and say, look, just look at your inventory ongoing. It doesn't cost you a whole lot of time or expenses. You already have an IT team. Just task them to look at the business continuity plan based on those applications. You already have it on your inventory, and evaluate their risk. So we can put that onto part of the risk profile and measuring it, and to identify the priority, what you have said, when should we prepare a budget to replace it? And I keep saying to my, the C-suite, my clients, that if your IT team cannot do that, then you have to evaluate whether that is a risk on its own, because 85% of the hack is initiating from human errors. And if your IT team, whether it's in-source or outsource, cannot even provide you with that inventory, cannot even provide with your risk profile based on the inventory, then I think it's time to have that communication, have that conversation, see what kind of collaborations to bring it into a different level from the approach into the strategy. And the strategy, what I said is that, NIST 8286 from our perspective, but in your regulatory, in your industry, it might be FFIEC, might be OCCs, might be FINRA, might be SEC. So it goes on and on. But again, I think that the point I'm trying to make is the word integrations, aggregations, and aggregating those informations. How do we normalizing it as part of the data analytic, for continuous measure and monitoring? So we got about 3 minutes left. What would you like to leave to our audience as your insights with this conversation we have?
Well, I guess the thing that I think that I've seen the most success in institutions, no matter how great or how small, is how much formalization do you actually bring into your process? Formalization is a mindset that can really help any and every organization, not just a credit union or a bank, financial institution, but any organization. And we're starting to see some of these organizations that are running some of these technologies like blockchain that are actually processing applications, bank applications, because they want to get bank charters. Now, they don't want to be banks, but what they want to do is they want access to that bin, because that bin is going to help them save cost and save money and be able to reach the customers using the technology that they have, that they want to establish in the marketplace. But one of the problems that we saw in our innovations office at the OCC is that many of these institutions are entrepreneurial in nature. And entrepreneurial institutions, they don't tend to be leaders in control structures and control infrastructures. They are there making money. They've got VCs and angel investors that they need to take care of. And so they need to make money. And they need to make money as quickly as they can. So in those particular cases, it leads me back into other institutions, financial institutions, who wanted to be even more going concerns. I think the more formalization you drive into your program, into your institution, formalization and enterprise risk, formalization with respect to audit and controls, formalization toward evaluating expertise and talent, the better it's going to be. And it will work its way through your institution to positively impact your risk profile, your appetite for risk, which will translate, believe it or not, into those who are publicly traded, your earnings per share. And I think in the bottom line, your institutions are going to be quite happy that you took the time to formalize these processes and ask these questions.
Excellent. Thank you, Steve. Really appreciate your excellent insights and experience sharing with us. So our audience, look us up on LinkedIn, Cyber Risk Governance Group. Thank you, Steve. And there's also where you can find Steve's information in our group as well. Thank you, Steve. And thank you everyone for listening. Bye-bye.
Thank you. Appreciate it. Bye-bye.